The other pocket, which is also shown diverse movements, is infrastructure. Now, two small-sized engineering, procurement and construction companies have outperformed peers this year, that too by a wide margin. And they have rallied even as the infrastructure sector is beset with multiple problems. Nikki Mirchandani is here to tell us about them and what they are doing and why is it that they are in the lead. Good morning, Nikki.
Good morning, Neeraj. You know, the infra space as a whole has not typically done quite well. From YTD basis, we've seen sharp declines coming in the range of around 2 to odd 80%. Several issues have weighed down in the industry, be it in terms of liquidity, be it in terms of getting the appointed dates, be it in terms of land acquisition. There are plenty of reasons out there for these performance. Actually, the company is not performing up to the mark. But then there are two small EPC contractors which are rather doing too well. They're not just outperforming the smaller peers, but then they're also outperforming the larger counterparts as a whole. If you look at these two names, PSP Projects and JMC Projects, they are the outperformers with gains of around 40 to 26% on YTD basis. Couple of things that have been going right for these small size EPC contractors. Let's get on to the reasons first, where we look at the kind of limited exposure that both these companies have typically to government, and more so particularly to NHAI, which at this point of time is rather perceived to be in a financial mess as compared to a PMO letter which talks about the feasibility and the kind of modus operandi of NHAI as a whole right now. So let's look at the order book profile of this company, JMC Projects, where we have 5% coming in from the government. Obviously, there is the infrastructure 35% also there, where part of which is coming in from the government side, but then again, there is no mention of NHAI anywhere here. Let's look at for PSP, where you would see some amount of government residential as well as the other government projects there. They're around 35 to 40% of the overall order book. Net, but then we again not looking at an NHAI exposure, which is a key point behind the strong performance and timely payment of these companies. Let's look at the other factor which is working well for both these companies as a whole now. Look at the faster execution rate. Now, JMC and PSP over the last 5 years, in terms of CAGR for the last 5 years, have grown at the rate of 15 and 57% respectively. Despite that, look at the kind of stability that they've shown in their execution. 2.8 goes to 3.2 times book-to-bill ratio for JMC, and for PSP, that's pretty much consistent around that 2 to 3 times. So, net, we're looking at the stability coming in terms of the execution performance despite the growing size of the order book of both of these companies. Now, let's look at the key metric out there, which is the balance sheet strength. As you know, the entire industry as a whole now is facing some amount of debt issues. But these are the two companies which have rather showed good performance. PSP Projects, look at that. Virtually, it's a debt-free company that we're looking at, and debt-to-equity ratio is actually gone down from 0.6 times to 0.07 times. Clearly, no debt company here. And let's look at JMC. For that, debt-to-equity ratio has rather halved in the last 5 years. From 1.4 times, it's gone down to 0.7 times. Some amount of good balance sheet strength also for this company. Let's look at the fourth parameter, which is working well, is the working capital, disciplined working capital approach that both these companies have shown. If you look at PSP, you'd be wondering why the numbers are in negative and then going into positive. Even if the requirements are going up, that doesn't mean it's doing well. If you look at as compared to the industry standards, it's probably the best working capital days that you would see in both for PSP as well as JMC also. It's completely stable at that 109 days, go to 113 days for that matter. So actually, let's look at what's in store for these companies, because they have outperformed, and rather see if there is more fuel to this rally. For JMC and PSP Projects, most of the analysts are bullish. Well, for JMC, 8 out of 8 analysts are suggesting a buy rating. For PSP as well, 7 out of 8 analysts are suggesting a buy rating. The potential upside now turns more in the favor of JMC, with a potential upside of 48% as compared to 15% seen by that of PSP Projects.
Nikki, is there a common theme? Do they have lower NHAI road exposures, and which is why their working capital days are also better? I mean, what is the thing that is working out for them
Yeah,
in
that's
common?
precisely what you pointed out. Lower exposure to NHI, rather no exposure to NHI, which is now perceived to be in financial mess, is clearly working in the favor of the companies because they're getting timely payments, because of which the working capital requirements are in control.
Okay, so not getting caught in arbitration in any fashion whatsoever, and that helps them in a big way.
Yeah.
Okay, and the book-to-bill ratio is also moving up for them. Is that a factor of applying for more state-run projects?
Yeah, so most of them are getting it from the government and the private companies as a whole, because of which the order book and the stable execution is also a factor at play for the outperformance of both these companies.
Okay, Nikki, thanks so much for putting that into perspective.